And it is great to be here with all of you today. What we're going to talk about, I'm going to introduce a little bit of short-term care. We got to hear a little bit about that as an option. And first of all, my name's Jamie Sarno. I am the Vice President of Medicare Supplement and Specialty Health for AmeriLife, and I've worked very closely with Aetna Senior Supplemental now for about 14 years. And promoting their short-term care plan, which is an amazing plan. So I've been 38 years in the industry for Medicare supplement, ancillary products, and especially long-term care. So I'm a big long-term care fan, always have been, always will be. But when long-term care isn't an option because of health or cost, it's good to know there are plenty other tools, as Tom just said, to fill that gap. So we're going to be resurrecting, Carol, this is for you, resurrecting the sale with short-term care. So, a typical scenario would be husband and wife. They both apply for long-term care coverage. And you know what happens? One is approved, one is declined. That can cause a lot of issues. Number one, I've seen it many times, the one that's declined is hurt. They feel even worse that they were declined. Maybe the husband gets the coverage, the spouse does not. And what will you hear them say? You'll hear them say, well, if she can't get it, I'm not going to take it either. And that's one of the worst things that can happen because they're leaving themselves wide open to financial harm, potentially, and nobody wants that. So what can you do? The decline rate right now, when you look at the percentages, you'll see, and let me move my screen here a little bit, you'll see that long-term care percentage, so 50 to 59, 20.4% are declined. Ages 60 to 64, 30.4%, and 65 to 69, 38.2%. And it makes sense. As we get older, we have more health conditions, which keep us from qualifying for guaranteed renewable long-term care coverage. And you know what happens once you get into your 70s. Now, most long-term care plans, they don't go into the 80s at all. So that leaves your clients that have made it to 80 years old have nothing at all. So there are choices out there, no matter what the age. And short-term care. So these are the Aetna stats, and these stats and percentages over the past 36 months, they're sampling of 25,000 applications. And you can see age 50 to 59, only an 8.7 decline rate, 60 to 64, 7.5%, 65 to 69, 7.8%, 70 to 74, 10.4%, 75 to 79, 12.2%, 80 to 84, 11.5, and 85 to 89, 8.4%. So to me, it's very important if I'm sitting with my clients, I don't want to hurt the relationship that I formed with them. If I'm a wealth manager, a financial planner, I want to make sure I'm taking care of them as holistically as I can, but I don't want to present something if I feel like they're not going to qualify because of their age or health. And that's not a good place to be because you know that there's a gap there, but what's the use in presenting it if they're not going to qualify? And if I do, am I going to hurt the relationship that I formed with them? Short-term care, especially Aetna recovery care, can be that answer. And I'm going to go into detail here on what the plans pay and what they do. But let me just give you an idea of the underwriting process. So much different from long-term care to short-term care. With long-term care, You'll have to get medical records, and not all of these, but most of these you're going to have to do to qualify for a long-term care plan. Medical records, RX check, a phone interview, a cognitive test, an MIB, paramedical, and medical exam. So again, not all of those, but a lot of those are used to determine if someone's going to be able to qualify. On short-term care, because you're talking about less duration, you're talking about less underwriting also. It's a yes/no application. And for Aetna, it goes back 3 years. So they're looking at your health over the past 36 months. And an RX check. With Aetna, you're going to find that something like blood pressure, diabetes, those are things that are not going to knock you out of your clients having coverage. There will be a 3-year look back on RX drugs. And what you're going to find is a knockout drug would be something like Parkinson's, epilepsy, congestive heart failure, the big ones. But Aetna understands that as you get older, you have more health conditions. So they're not going to be judgmental on any little thing that you have. So one of the main points I want to get across on short-term care, because a lot of it, it should say, don't be scared of short-term care also, because a lot of agents and representatives out there think that just because it's called short-term care, that's a negative. And I agree. I'd rather something be long-term than short-term, but it's all relative to the daily dollar benefit that the plan is paying. And I'll give you a for instance here. So if we take long-term care insurance, and let's just say it's a 3-year plan, and I did a modest $150 per day with a 100-day elimination period, the total benefit on that plan would be $164,250. If you take a short-term care plan of 360 days, and I front load that with $400 a day with a 0 elimination, what you'll find is there's $144,000 worth of benefit there. So you're very close. Now, if you take into account that the long-term care plan does have a 100-day elimination period, what's going to happen is this. That's a $27,583 deductible or self-pay. On the short-term care, there is no elimination period, 0 deductible. So what you're going to see is it's beneficial, and it's all determining on how much they're getting per day. With a short-term care plan at Aetna, and it's called recovery care, what you're going to find is it's an indemnity plan. It's going to pay its face amount. If you have $400 a day, it's going to pay the entire amount to the insured, regardless of the cost of the nursing facility. So whether it's assisted living, whether it's a nursing facility, if you have $400 a day, they're charging $300. You're going to get paid the full $400. And you can bank that to extend that 360 days. And that's a good place to start with. What is the difference between long-term and short-term care other than the name? Well, any benefit that pays 365 days or more is long-term care. Anything under 365 is short-term care. They're identical benefits. Again, the duration is shorter. Now, what you're going to find, Aetna, again, household name. They have an AM Best rating of A Excellent, and they are ranked 6th in the Fortune 500's top health companies. They were established May 28th in 1853, and they paid the very first Medicare claim. So a long, rich history with the Aetna name. All of you know the Aetna name, and it resonates with the public, with the consumer. So when you're talking to them, it does give them the confidence in the name and in the history of Aetna, because Aetna has taken care of our retired teachers for many, many decades, and they're just well known around the world. So let's dig deep into what this benefit can actually do, how you can break it down and really customize it to fit your client's needs. First of all, it is called recovery care, but don't let the name fool you. It is for nursing facility and assisted living. And what you're going to find is the plan will pay anywhere from $10 a day up to $400 maximum. And I will let you know this, you're going to see in probably the next 12 to 18 months, that's going to go even higher. So it'll even help more with that duration. You can choose covered days of 90 days, 180 days, 270 days, and 360, just under 1 year. The lifetime maximum is equal to twice the number of covered days. So what that means is this: if someone has $400 a day for 360 days, they're allowed to use that twice in a lifetime. Just has to be separated by 6 months where they did not need care. They could perform 5 of 6 activities of daily living. Pretty easy to reuse. And you have a choice of waiting period of 0 to 20 days or 90 days. You can add, and they don't call it an elimination period, they call it a waiting period. And issue ages are age 50 to 89. So you're going to find gives you a large span there to get your clients, even those at an older age, get them some type of coverage. Because right now, what you're going to find, especially with observation stays in the hospital being on an uptick, if someone goes into a hospital and they are under observation, the 3-day hospital stay required as an inpatient for Medicare to pay, you don't get anymore. So if Medicare doesn't pay the first 20 days, a Medicare supplement cannot pay day 21 through 100. And what we're finding is a lot of seniors are leaving a hospital where they weren't considered inpatient. They get to the nursing facility and they're being asked for $10,000 just for the first month. So these are issues that are growing in the senior market and with Medicare. And Aetna has had a very good track run with taking care of the Medicare supplement, Medicare Advantage individuals out there that are looking for extra coverage. Now, you can also add what's called a home care rider. And it actually extends, it will take that 360-day nursing facility plan and add an additional 52 weeks of home health care. So now you get 2 years within one plan. It will pay up to $1,200 weekly. You can choose a 13, 26, and 52-week plan. You also get that twice in a lifetime where you can use that 1 year 2 times. So you add those 2 together, you're getting 4 potential years of coverage out of a short-term care plan. Issue ages, of course, 50 to 89. And with it being an indemnity plan, it has a minimum. They do not take nurses' notes like long-term care every day that the nurse comes in. How long were you there? What did you do? It's simply this: 3 one-hour visits on separate days during 1 week. That's the minimum. Just those 3 one-hour visits, the entire benefit is paid to the insured. That money is theirs to spend as they wish. They're not restricted in any way, and it is non-taxable. So in wrapping up here, just to give you an example of the pricing, I've taken age 50, that's where it starts. If you give them a maximum benefit of 360 days at $400 a day, you're going to find that's $144,000 for the 360-day period. If you add the home care benefit of $62,400, that's a combined total benefit of $206,400. And the premium for a 50-year-old would be $102.85. So what you're going to find, these plans that Aetna has had, they've had them since 1996. They have never had a rate increase in all that time. It's a very stable plan. You have the Aetna backing and reputation and the great actuaries there. It's just a different animal than long-term care. So what I want to stress is when that sale seems like it's going to fall through, offer up a short-term care plan through Aetna, give them the confidence that they need, and that will truly save your long-term care issues with a decline. So I appreciate everyone's time today. Please contact me, and we'll get you set up with Aetna and answer any questions you have. So let's go on to the next presenter.